Florida's rental market is tearing itself apart. Right now, in 2026, two massive forces are colliding with devastating consequences for thousands of investors. Short-term vacation rentals are suffocating under brutal oversupply, while long-term residential rentals bleed tenants by the thousands. Insurance costs have quadrupled. Property taxes are crushing cash flow. And investors who poured millions into Florida real estate during the pandemic boom are now racing to dump properties before the bottom falls out completely. This isn't a prediction. It's happening as we speak. Across Miami, Tampa, Orlando, and Jacksonville, rental properties that once printed money are now drowning owners in red ink. But here's the question that's keeping real estate investors awake at night. Which segment collapses first? The data reveals a brutal answer, and it's going to shock anyone holding rental property in the Sunshine State. According to CoStar Group analysis, vacancy rates have surged while occupancy patterns show dangerous instability in both markets. Miami was recently crowned the hottest rental market in America by Rent Cafe, with 19 renters competing for every vacant apartment. Yet, beneath that headline, a different story is unfolding. Airbnb occupancy rates in Miami sit at just 62%, down from peaks above 75% 2 years ago. Something doesn't add up, and when you dig into the numbers, the picture gets uglier fast. The truth is, both markets are vulnerable. Both are bleeding, but one is far closer to systematic collapse than the other. In this breakdown, we're dissecting the data, exposing the vulnerabilities, and revealing which rental market in Florida is about to implode first. Subscribe to Housing Intel for data-driven real estate intelligence you won't find anywhere else. The Airbnb oversupply apocalypse crushing Florida hosts. Florida's short-term rental market is facing an existential crisis. Between 2020 and 2025, the number of active Airbnb listings exploded across the state. Orlando alone saw active listings surge to over 21,000 properties, up from fewer than 8,000 just 5 years ago. Jacksonville, Tampa, and Miami followed similar trajectories. Investors convinced that vacation rentals were passive income, gold mines flooded the market with inventory. Now, in 2026, they're drowning in competition and vanishing profits. Occupancy rates tell the brutal story. Coconut Grove in Miami, once a short-term rental darling, now shows a 64% average occupancy rate across its 452 active listings. That means properties sit empty over 1/3 of the year. Miami overall clocks in at 62% occupancy across 7,106 active Airbnb listings, with average daily rates of $308, producing projected annual revenue of just $53,505. Sounds decent until you factor in the costs that are eviscerating hosts. Tampa tells an even grimmer tale. With over 9,000 active Airbnb listings and occupancy hovering around 61%, the market is saturated beyond recovery. Average daily rates of $239 translate to annual revenue projections of $41,798. But here's the nightmare. Insurance premiums in coastal Florida now average $8,000 to $12,000 annually for properties in flood zones. Add property taxes, HOA fees, maintenance, utilities, cleaning services, and platform fees, and most Tampa Airbnb hosts are barely breaking even or operating at a loss. Orlando presents the worst oversupply scenario. 21,000 active listings compete for the same pool of Disney tourists and convention visitors. Occupancy rates have plummeted to 58%, with average daily rates of $222, generating estimated annual revenue of just $37,494. That's before expenses. The The math simply doesn't work anymore. Hosts who leveraged properties with high-interest debt during the pandemic are now trapped in a vicious cycle. They can't cover mortgage payments. They can't sell without massive losses. And they can't pivot to long-term rentals because that market is imploding too. Jacksonville's short-term rental market has been described as experiencing a brutal crash, with oversupply and debt-crushing hosts. Active listings have more than tripled since 2020, while tourism hasn't kept pace. Investors who bought properties specifically for Airbnb income are now facing the harsh reality that occupancy below 60% makes the entire business model unsustainable. Many are listing properties for sale, adding to Florida's already bloated inventory of over 73% more homes on the market compared to last year. The Airbnb collapse isn't just a Florida problem, but Florida is ground zero. The combination of oversupply, falling tourism demand, skyrocketing insurance costs, and mounting regulation has created a perfect storm. Cities like Miami are cracking down on illegal short-term rentals in residential buildings, with Brickell condo owners pushing officials for aggressive enforcement. Hosts are weary of regulations, competition, and diminishing returns. The exodus has begun. If you're seeing the danger here, hit that subscribe button to Housing Intel. This is the kind of market intelligence that separates winners from losers. Long-term rental vacancies surge, devastating landlords. While short-term rentals drown in oversupply, long-term rentals face their own catastrophic reckoning. Florida's apartment vacancy rate hit 6.9% by mid-2025, up from 5.8% just 1 year earlier. That represents thousands of empty units across the state, and the trend is accelerating into 2026. Miami leads the vacancy crisis with a staggering 7.8% vacancy rate, the highest among major Florida metros. That's thousands of apartments sitting empty in a city that supposedly has 19 renters competing for every unit. The contradiction exposes the real story. Demand exists at lower price points, but landlords who bought or built during the boom can't afford to drop rents low enough to fill units without destroying their cash flow. Median rents are collapsing across Florida's major markets. Miami median rent dropped to $3,000, down 6.2% year over year. Tampa median rent fell to $2,100, a 5% decline. Orlando clocked in at $2,000, down 4.3%. These aren't minor corrections. These are systematic retreats driven by oversupply and evaporating demand. The root cause? A massive wave of multifamily construction that flooded the market between 2021 and 2024. Developers, flush with cheap pandemic-era capital and betting on endless migration to Florida, built tens of thousands of new apartment units across Tampa, Orlando, and Miami. Those units are now hitting the market simultaneously, creating brutal competition for tenants. According to CoStar Group data, some apartment investors are calling the oversupply a short-term problem, but the fundamentals suggest otherwise. Tampa offers a microcosm of the crisis. Despite being ranked the fourth hottest rental market in Florida by some measures, the reality on the ground is grim. New construction added thousands of units to a market where demand couldn't keep pace. Landlords are now offering incentives unheard of just 2 years ago. Free months of rent, waived application fees, paid utilities, even cash bonuses for signing leases. These concessions signal desperation, not strength. Orlando faces similar pressures. The combination of overbuilding near tourist corridors and softening demand from service industry workers has created a tenants market. Renters have leverage they haven't had in years, negotiating lower rents and better terms. For landlords, this means shrinking margins and negative cash flow on properties that were supposed to be cash cows. Jacksonville and other secondary markets aren't immune. Vacancy rates are climbing, rents are falling, and landlords who overpaid for properties during the boom are facing a brutal reality. They can't raise rents high enough to cover rising expenses. Insurance premiums have increased 400% over 5 years across Florida. Property taxes keep climbing. HOA fees for condos are spiking as buildings address deferred maintenance. The squeeze is relentless. Some landlords are trying to pivot failing Airbnbs into long-term rentals, flooding an already saturated market with even more inventory. This creates a cascading effect, pushing vacancy rates higher and rents lower. It's a race to the bottom, and everyone loses except tenants who can suddenly negotiate aggressively. The long-term rental market isn't collapsing as dramatically as short-term rentals, but it's bleeding slowly and steadily. Cash flow is evaporating. Equity is stagnant or declining, and investors who thought Florida real estate was a safe bet are discovering that oversupply kills returns just as effectively in long-term rentals as it does in Airbnbs. The insurance crisis destroying both markets simultaneously. If there's one factor crushing both short-term and long-term rentals with equal brutality, it's insurance. Florida's homeowners insurance market has effectively collapsed. Premiums have surged 400% over the past 5 years, driven by climate risks, catastrophic hurricanes, and insurers fleeing the state entirely. For coastal properties, annual insurance premiums now range from $8,000 to $12,000, with some high-risk properties unable to find coverage at any price. Major carriers have pulled out of Florida entirely, forcing homeowners into the state-run Citizens Property Insurance Pool, which offers expensive coverage with significant gaps. This isn't a temporary spike. It's structural, driven by actuarial reality and climate change. For Airbnb hosts, insurance costs alone can wipe out profit margins. A property generating $50,000 in annual revenue sounds attractive until you subtract $8,000 to $12,000 for insurance, $5,000 to $8,000 for property taxes, $3,000 to $5,000 for HOA fees, $2,000 for platform fees, and another $5,000 to $10,000 for maintenance, utilities, and cleaning. What looked like a profitable investment becomes break-even or negative cash flow overnight. Long-term rental owners face the same insurance nightmare. A landlord collecting $36,000 annual rent on a $3,000 per month unit sees that income evaporate when insurance costs $12,000. Property taxes take another $6,000, and maintenance eats another $4,000. The math doesn't work. Rising insurance costs have fundamentally altered the economics of Florida rental properties, making previously viable investments unsustainable. Cape Coral exemplifies the insurance crisis impact. Homeowners in this canal-heavy city now pay $8,000 to $12,000 annually for flood zone insurance, with some unable to find willing insurers at all. This affects both short-term and long-term rentals equally, crushing cash flow and forcing owners to either subsidize properties from personal funds or sell at steep losses. The insurance weapon is non-discriminatory. It destroys Airbnb margins and long-term rental cash flow with equal ferocity. And it's not going away. If anything, climate risks are intensifying, meaning insurance costs will continue climbing. Any rental property owner in Florida who hasn't factored in 4-figure monthly insurance costs is operating in fantasy land. Investor panic and the mass exodus accelerating the crash. Florida real estate investors are in full retreat. Property inventory has exploded 73% year over year, with 42% of sellers slashing prices in desperate attempts to move properties before the market deteriorates further. This isn't normal selling activity. This is panic. Investors who bought rental properties between 2020 and 2022, at the absolute peak of the pandemic boom, are now underwater. They overpaid for properties, took on high-interest debt, and bet that rents and occupancy would keep climbing forever. Instead, rents are falling, vacancy is rising, and expenses are skyrocketing. Many are facing a stark choice: keep bleeding cash every month or sell at a significant loss. The Airbnb investor exodus is particularly dramatic. Hosts who bought properties specifically for short-term rental income are discovering that occupancy below 65% makes the model unsustainable. Debt service on mortgages taken at 6 to 7% interest rates consumes most or all of the revenue. Add insurance, taxes, and maintenance, and losses pile up fast. These investors are racing to dump properties, flooding the market with inventory and driving prices down further. Long-term rental investors face similar pressures. Those who bought multifamily properties or single-family homes for traditional rentals are watching cash flow evaporate as rents fall and expenses rise. Refinancing isn't an option with interest rates still elevated. Selling means taking a loss. Holding means burning cash every month. It's a trap, and thousands of Florida landlords are caught in it. According to Bloomberg-backed analysis, investor retreat is accelerating the housing market correction across vulnerable Sunbelt markets, with Florida leading the decline. Properties that once had multiple offers now sit for 90 to 120 days with price cuts. Some desperate sellers are offering to cover closing costs, buy down mortgage rates, or throw in furniture just to move inventory. The fire sale mentality is spreading. As more investors dump properties, comparable sales decline, pushing home values down across entire neighborhoods. This creates a negative feedback loop, where falling prices trigger more panic selling, which drives prices down further. It's the beginning of a crash, and both rental segments are caught in the spiral. The verdict: which market crashes first? So which rental market collapses first? Short-term or long-term? The data points to a clear answer, and it's not even close. Short-term rentals are far more vulnerable and will experience systematic collapse first. Here's why. Airbnb and vacation rental economics depend on high occupancy rates, typically 70% or higher, to justify the elevated costs of short-term operation. Current occupancy rates across Florida metros are in the low 60s or worse, below the break-even threshold for most highly leveraged properties. There's no cushion. When occupancy drops 5 to 10 percentage points, the entire business model implodes. Short-term rentals are also tourism-dependent, making them vulnerable to economic downturns, travel trend shifts, and seasonal fluctuations that long-term rentals don't face. As recession fears mount in 2026 and discretionary travel spending tightens, Airbnb bookings will decline further, pushing occupancy rates into catastrophic territory. Regulation risk hits short-term rentals harder. Cities across Florida are cracking down on illegal rentals, imposing stricter licensing requirements, and responding to resident complaints about noise and neighborhood disruption. Miami, Tampa, and other municipalities are strengthening enforcement. Every new restriction shrinks the viable host pool and pushes more investors toward exits. Debt leverage amplifies short-term rental vulnerability. Many Airbnb investors bought properties with minimal down payments, betting on cash flow to cover mortgage payments. With occupancy falling and expenses rising, debt service becomes unsustainable quickly. Foreclosures and distressed sales will spike first in the short-term rental segment. Long-term rentals have more staying power, but they're still bleeding badly. Landlords can absorb lower rents and higher vacancy longer than Airbnb hosts can absorb sub-60% occupancy. Long-term leases provide some revenue stability that nightly bookings don't. And long-term rental properties often have lower debt loads than speculative short-term purchases. But don't mistake crashes second for doesn't crash. Long-term rentals are facing systematic oversupply, falling rents, and the same insurance and tax pressures destroying short-term rentals. The collapse will be slower, but equally painful. Expect long-term rental distress to accelerate 6 to 12 months after short-term rentals implode, as Airbnb hosts desperately pivot failing properties into an already saturated long-term market. The timeline is clear. Short-term rentals are in freefall now, in 2026. Long-term rentals will follow by late 2026 into 2027. Both markets are doomed by oversupply, unsustainable costs, and investor panic. The only question is, which investors exit fast enough to minimize losses? The brutal reality no one wants to admit. Florida's rental market isn't cooling. It's collapsing under the weight of its own excess. Investors who believed the Sunshine State was recession-proof and that rental income would flow forever are learning a painful lesson. Oversupply kills returns, and Florida is drowning in inventory. Short-term rentals will crash first, violently and visibly. Long-term rentals will crash second, slower, but just as devastatingly. Both segments are facing structural problems that can't be solved by waiting for better conditions. Insurance costs aren't coming down. Property taxes aren't decreasing. Oversupply isn't disappearing overnight. For investors still holding Florida rental properties, the message is stark. Evaluate your position ruthlessly. If you're cash flow negative or barely breaking even, consider exiting before the market deteriorates further. If you're highly leveraged with adjustable rate debt, you're sitting on a time bomb. If you're betting on a quick recovery, you're likely delusional. The warning signs are flashing red across every metric. Occupancy down, vacancy up, rents falling, inventory exploding, investor exodus accelerating. This isn't a dip. It's the beginning of a multi-year correction that will wipe out paper gains and trap over-leveraged owners in properties they can't afford and can't sell. Armed with this data, you can make informed decisions while others cling to hope. Knowledge is protection in a collapsing market. So if this analysis opened your eyes, smash that like button right now. Subscribe to Housing Intel for weekly data-driven real estate intelligence that cuts through the hype and shows you what's really happening. And drop a comment below. Are you holding short-term rentals, long-term rentals, or did you already exit Florida? We read every single one. We'll see you in the next breakdown, because sometimes knowing what not to own is the best investment decision of all.